MegaWorld REIT, MREIT, has quietly delivered strong results in 2024 to 2025, raising the question, is this high-yielding REIT the hidden gem of Philippine real estate? On a last close around 13.80 pesos as of June 2025, MREIT yields roughly 7 to 7.5% annual dividends. But beyond the juicy payout, we'll dive into the numbers. Recent revenues, earnings, NAV per unit, occupancy and debt levels, and how its stock has performed. Along the way, we'll compare MREIT's metrics to AREIT, FILRT REIT, Double Dragon REIT, and RL Commercial REIT. By the end, you'll know if MREIT's growth prospects and sponsor support make it a buy, or if there are hidden risks lurking in the details. MREIT is the office property REIT sponsored by MegaWorld Corporation, launched in 2021. It focuses on Grade A office towers in MegaWorld's key townships. Today, MREIT's portfolio spans 24 premium office buildings in 5 townships, including Eastwood City, McKinley Hill, McKinley West, Iloilo Business Park, and Davao Park District. These include landmark towers like 1800 and 1880 Eastwood Avenue, the Techno Place and Global Center blocks in Iloilo, and the new West Campus Towers in McKinley. Under CEO Kevin Tan, MREIT aims to grow steadily. It's targeting about 100,000 square meters of new leasable area each year, on its way to a massive 1 million square meters by 2030. MREIT positions itself as Philippines' most premium offices, drawing on MegaWorld's township ecosystems. MREIT's management team focuses on extracting value through high occupancies, rental escalations, and accretive acquisitions. MegaWorld's backing means MREIT can tap into a pipeline of new office assets or even mall properties if regulations allow, which underpins its growth outlook. Revenues and income. MREIT's growth has been impressive. In 2024, MREIT generated roughly 3.46 billion pesos in revenues, up 7.5% from 3.22 billion pesos in 2023. Net income jumped to about 3.97 billion pesos in 2024, a 22 times increase from the prior year. This large jump reflects full-year earnings contributions from assets acquired mid-2023 and late 2024. MREIT's latest quarterly report shows continued momentum. Revenues were 1.34 billion pesos in Q1 2025, up 25% from 1.08 billion pesos in Q1 2024. Distributable income or net profit rose 31% to 963 million pesos in Q1 2025 versus 733 million pesos a year earlier. This jump was driven by the full quarter rental contribution from 6 new PACE-accredited office properties acquired in late 2024, as well as ongoing rental escalations in the existing portfolio. Management remains optimistic. They declared a Q1 dividend of 25 cents per share, payable June 2025, implying an annualized yield of 7.18% based on the May 2025 share price. Occupancy and rent. At end 2024, overall portfolio occupancy was about 91%. This is slightly below peers, but still healthy, reflecting some vacancies in older buildings in transition as new assets were leased. The average rent was roughly 778 pesos per square meter each month, 2024 average. Key buildings like One World Square, McKinley Hill, had some vacancy, 72% occupancy, while core towers like Eastwood's 1800-1880 Avenue were fully leased. Industry-wide, MREIT's office rents in Manila fall in the mid-high range, especially in its Makati submarket, averaging 900 pesos to 1,500 pesos, well above second-tier markets. Balance sheet and net asset value. MREIT ended 2024 with gross leasable area of 482,000 square meter, up 48% from 2023 after the Wave 3 acquisitions. On the balance sheet, it carried about 7.21 billion pesos in interest-bearing debt at end 2024. This was a single long-term loan taken in 2021. MREIT has relatively low leverage for its size. Key 2024 to 2025 figures. 2024 revenue, 3.46 billion pesos, up 7.5% year-on-year. 2024 net income, 3.97 billion, up 2,260% versus 2023. Q1 2025 revenue, 1.34 billion pesos, up 25% year-on-year. Q1 2025 net income, 963 million pesos, up 31% from 2024. Dividend, 0.25 pesos per share for Q1 2025, annualized yield 7.18%. Gross leasable area, 482,000 square per meter as of the year-end of 2024. Occupancy rate, 90 to 91%. Bank debt, 7.21 billion pesos as of year-end 2024. MREIT's growth story hinges on accretive acquisitions. At IPO 2021, it inherited several finished office buildings. In April 2024, it announced a major Wave 3 property for shares swap, 13.15 billion pesos, for 6 additional buildings totaling 157,000 square meters. These included 2 West Campus, 10 West Campus, 1 La Grande, all in McKinley West, 1 Fintech Place and 2 Fintech Place, Iloilo Business Park, and Davao Finance Center, Davao Park District. The transaction, approved mid-2024, substantially boosted portfolio to 482,000 square meter, a 48% jump, and was done by issuing 926 million new MREIT shares at a premium. Management noted this made MREIT dividend accretive, meaning the new assets rent would raise future distributions. Beyond that, MREIT continues eyeing sponsor assets. A June 2023 announcement detailed plans to acquire 7 office towers, including Science Hub Towers and Bacolod projects, by late 2024. This pipeline shows MegaWorld channeling its unsold office inventory into the REIT. The goal, reach 600,000 square meter gross leasable area by end 2025 and 1 million by 2030. In summary, the portfolio now spans 24 offices in 5 central business districts. Most are BPO-grade towers, 85% plus leased to tenants like call centers, corporates. With these assets, MREIT is on track to become one of the country's largest office REITs. One reason MREIT is touted as a hidden gem is its rich yield. As of mid-2025, MREIT's trailing dividend yield is around 7 to 7.5%. For context, in Q1 2025, MREIT announced a 0.25 pesos dividend per share, annualized of 1 pesos per share, on a share price around 14 pesos. The stock trades at a price-to-earnings ratio of around 10 to 12 times based on 2024 earnings per share of 1.37 pesos per share. Another important point is that MREIT's dividend payout ratio is healthy and covered by distributable income. On the balance sheet, MREIT's net debt to equity is relatively conservative, with 9.8 billion pesos debt versus roughly 76 billion pesos asset value. Leverage is moderate. MREIT is in that low leverage ballpark. A bonus, MREIT's cash flows are largely contracted, tenant leases have built-in escalations, and many tenants are investment grade. On costs, any sharp interest rate hike could increase financing costs, but 90% of MREIT's gross leasable area leases have escalations indexed to inflation or fixed increments, providing some hedge. Share price performance. MREIT IPO'd at 16.10 pesos in 2021, but trades 13 to 14 pesos now. Its 52-week range has been roughly 12.64 to 14.10 pesos. Year-to-date 2025, its stock has a minimal growth. Part of this is high supply of newly issued shares from acquisitions and a conservative market sentiment. Yet the low price makes its yield attractive. Key metrics. Price to book value per share is under 1. Net asset value per share isn't regularly published for PH REITs, but the PSE annual report suggests MREIT's book value per share is in the mid-17s of pesos. This indicates that the stock may be undervalued, especially when measured against its book value per share. Let's compare MREIT to other major Philippine REITs on key metrics. Dividend yield. MREIT's 7.4% yield is high among its peers. For context, AREIT yields only 5.9%. FILRT REIT yields about 7.9%. Double Dragon Mall REIT, which owns malls, yields roughly 9%. RL Commercial REIT, with office and malls, yields on the order of 6 to 7%. MREIT is near the top. Higher yields reflect both its aggressive payouts and the market valuing it below book. AREIT's lower yield signals its premium valuation and near-full occupancy, whereas Double Dragon's highest yield comes with higher risk, mall sector, and lower share price. Occupancy and asset quality. MREIT's occupancy, 90 to 91%, is a bit below some peers. AREIT is at 99% occupancy by Q1 2025. FILRT REIT's offices also have mid-90% occupancy. In contrast, RL Commercial, mostly Robinson's offices and malls, is 96% occupied. MREIT's slightly lower occupancy reflects that some newer or fringe assets, such as One World Square, had lease-up periods. But management expects occupancy to improve with tenant demand and as new leases roll in. Debt and leverage. MREIT's debt-to-equity is on the lower side. For example, AREIT's net debt to equity was only 0.02. RL Commercial REIT has no bank debt. It reported no outstanding borrowings as of Q1 2025. MREIT's 7.2 billion pesos debt supports 62 billion pesos in assets, a modest leverage for a growth REIT. FILRT REIT carries moderate debt 6 to 7 billion pesos on 40 billion pesos in assets. So MREIT sits in the lower leverage range, which is positive for stability. Share performance. As of January to July 2025, MREIT stock trading around 14 pesos. AREIT's was up 8% year-to-date. FILRT REIT moved up 11%. Double Dragon REIT gained around 4%. RL Commercial REIT stock has grown 27% year-to-date. Growth outlook. The Philippine economy and the BPO and corporate sectors remain robust, underpinning office demand. MREIT's portfolio is concentrated in high-growth zones, Manila's central business district extensions like Eastwood, Taguig, and regional hubs like Iloilo and Davao. MegaWorld expects more gross leasable area in Fusion each year. Management aims to add 100,000 square meters annually. Future acquisitions from a sponsor could include new office towers or even commercial buildings. The 1 million square meter 2030 target is ambitious but shows MREIT's scale-up vision. Rising rents on lease renewals, with steady rental escalations, will further boost income per square meter. Macroeconomic and industry risks. A key risk is office market conditions. If a downturn hits, for example, more supply outstrips demand, occupancy or rents could slip. Currently, office vacancy in Metro Manila is around 20%, so MREIT's 90% occupancy is solid. However, competition from new offices and hybrid work trends could challenge future leasing. Interest rates are another consideration. Higher rates could pressure REIT valuations and raise MREIT's financing costs, though MREIT has locked-in debt. Currency or political instability could affect foreign investor appetite, though MREIT has limited foreign ownership. Sponsor or concentration risks. MREIT is tied to MegaWorld, so its acquisition pipeline depends on that relationship. If MegaWorld decides to slow asset injections, MREIT's growth could stall, as happened temporarily before the last infusion. Also, MREIT's revenue is heavily weighted to office leases. It currently has no retail or residential assets, which diversifies some risk but means it lacks alternative income streams in slow office markets. Investors should also watch for any insider stock issuances or related party transactions. The big acquisitions were done via share swaps, which diluted existing shareholders. In summary, is MREIT a hidden gem? Its numbers say it's a high-yielding, fast-growing office REIT backed by a top developer. MREIT's 7% dividend yield is among the highest in PH REITs, and its earnings have grown strongly thanks to recent acquisitions. Its portfolio of Class A offices in megaworld townships should stay in demand, and management has a clear roadmap: 600,000 square meters by year in 2025, 1 million square meters by 2030. However, investors must weigh the risks. Occupancy is good, but not as rock-solid as AREITs, and MREIT still depends on sponsor-driven asset additions. The current share price implies a discount to net asset value, so there may be upside if everything goes right, but also room to fall if the office market softens or if MREIT overpays for acquisitions. Our take: for yield-hungry investors comfortable with some volatility, MREIT looks compelling in mid-2025. Its yield is high, while still having a levered growth story. We keep an eye on how Q2 results track occupancy and any new acquisitions. If you're bullish on Philippine office demand and trust Megaworld, MREIT could indeed be a hidden gem worth a spot in your REIT portfolio. Thanks for watching this deep dive on MREIT. If you found this helpful, like and subscribe for more investing updates.